The formation of a corporation, partnership, or LLC is heavily influenced by state law. Over time, however, state law differences between these organizational forms shrank substantially, making it difficult for business owners and tax authorities to determine how an entity should be treated for federal tax purposes. The Treasury issued regulations in 1996 to combat this problem. In this lesson, you will learn about these so-called check-the-box regulations. Code Section 7701A3 defines a corporation as including associations, joint stock companies, and insurance companies. Based on this vague definition, an unincorporated association should be treated as a corporation for federal tax purposes, right? Maybe. Welcome to tax. The issue is that the code does not define the term association, which led to many years of litigation. It was eventually decided that an entity would be treated as a corporation if it possessed a majority of the traits common to corporations. These traits included the advantages of the corporate organizational form: continuity of life, centralized management, limited liability, and free transferability of interest. These traits, however, were not always diagnostic. For example, as the various states began adopting laws permitting the formation of LLCs, there was a lot of confusion about how these entities should be treated for federal tax purposes. Why? Many state LLC provisions provided limited liability and centralized management, but not continuity of life or freely transferable interests. That is, exactly 1/2 of the corporate traits rather than a majority. Of course, taxpayers hoped this meant the entity would be treated as a partnership, avoiding the double taxation of Subchapter C. To help solve this issue, the Treasury issued the so-called check-the-box regulations, which allow taxpayers to choose the federal tax status of a business entity without regard to its specific traits. The goal is to simplify tax administration and eliminate litigation over the proper tax classification. Under these regulations, an unincorporated entity with more than one owner is, by default, classified as a partnership. An unincorporated entity with only one owner is, by default, a disregarded entity, which is treated as a sole proprietorship if owned by an individual, or as a branch or division if owned by another business entity. If an unincorporated entity desires to choose a status other than the default, it simply checks the box on Form 8832, quite literally. For example, an LLC with one or many members can choose to be taxed under Subchapter C, or if it meets other restrictions, Subchapter S. However, only unincorporated entities are permitted to check the box. In other words, as you might expect, entities incorporated under state law are required to be taxed as corporations, either Subchapter C or Subchapter S if eligible for federal tax purposes. An LLC is not viewed as incorporated even though state laws govern the formation and operation of such entities. The classification of an entity as a corporation is largely unaffected by changes in ownership. However, if an entity is classified as a partnership and ownership is reduced to one owner, it converts to a disregarded entity. Similarly, a disregarded entity becomes a partnership when it obtains multiple owners.